Hi, this is Ian Gendler, Director of Research at ValueLine. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. For those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I feel it is important to start with an update on the current economic environment. This content was created by Harvey Katz, ValueLine's chief economist. Investors remain riveted on our trade dispute with China, with the ebb and flow of events on that front continuing to influence daily action on Wall Street. So, when it seems as though the gulf between the two economic giants is widening, the market suffers. When the news is better, the bulls tend to regain the upper hand. Recently, sentiment has become somewhat more positive. This has led to speculation that a preliminary trade understanding may be in the works. The hope is that these early efforts will lead to a more definitive, longer-term trade arrangement. Meanwhile, the trade standoff is affecting our economic well-being, with the tariffs proving a drag on GDP growth. A 3-month contraction in manufacturing, the stalling of job growth in that sector, and the pressures felt by both farmers and retailers are combining to hamper growth. So, after our economy breezed through 2018, gaining close to 3%, and advanced nicely early this year, the upturn has slowed. In all, GDP rose just 2% and 1.9%, respectively, in the second and third quarters. A slowing into the 1.5% to 1.8% range appears likely in the current quarter. Trade's impact on earnings has been uneven. The third quarter was decent, with results generally beating expectations. But there were disappointments, in particular among some bellwether industrial enterprises. On balance, though, the performance was sufficiently strong to give the market a nice lift. The Federal Reserve is likely to remain supportive. True, Fed Chair Jerome Powell continues to signal that the bank is in no hurry to reduce interest rates further. That is especially so with the economy seemingly poised to deliver sustained growth. Meanwhile, the relatively low rate of inflation and the sluggish pace of improvement in certain business categories suggest that the lead bank will be in no hurry to raise borrowing costs either. The economy is likely to retain its resilience. Possible progress on trade, the impact of low borrowing costs, a post-work stoppage rebound in production at General Motors, and a hopeful recovery in Boeing's production of the 737 MAX aircraft could nudge GDP growth back above 2% next year. This backdrop continues to favor equities. The road higher will not be easy, however, as stocks already are in record territory. Still, the case for further gains is stronger than the argument for a meaningful pullback. In conclusion, we think holding a solid position in quality stocks with favorable earnings and dividend prospects is prudent at present. We can use Harvey's comments and outlook to create an investment strategy. Thankfully, Value Line provides the tools to put this in action, which I will demonstrate when I get to the screener. Before we formally start our search, please note that I'm already signed in as a subscriber on the Value Line dashboard. From here, I can access all of the products, as well as view the daily market commentaries, economic information, as well as general interest articles written by our analyst team. Although earnings season is winding down, important information can be gleaned from our free reports on the quarterly results of the Dow 30. For instance, just yesterday, Home Depot reported disappointing revenues and sales guidance. We invite everyone to review our updated analysis. Let's now start our search for a worthwhile investment candidate. For this, I'm going to head to the screener, which can be accessed via the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's focus on the details that Harvey mentioned in his report. To repeat his conclusion, we think holding a solid position in quality stocks with favorable earnings and dividend prospects is prudent at present. First, let's address quality. While we are bullish in regard to the market over the near term, there are certainly a number of concerns, including trade, economic conditions, etc. Thus, I'm going to weed out risky equities so that we can indeed focus on quality. There are loads of risk measures out there, and that Value Line offers, and I'm going to focus on our time-tested safety ranks. The safety ranks measure the total risk of a stock and is arranged on an easy-to-understand 1 to 5 scale, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. So I click on the safety rank field, and I want to focus on stocks ranked 1 or 2. These are the most financially sound companies that we track, and their stocks have a history of relative stability. As you can see, only 460 stocks in our database of more than 5,800 are ranked highly for safety. Now let's address favorable earnings prospects. This is where Value Line's 3 to 5 year projections are particularly useful. It's also a good time to mention that Value Line is one of very few research houses that provide financial projections out 3 to 5 years. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. So for this field, I'm going to select projected 3 to 5 year EPS growth and set the low bound to 10%. And click Filter. For dividends, I'm going to utilize 2 fields. First, the current yield, and then the historical dividend growth. Each week, on the front cover of the Summary Index, we publish the median of estimated dividend yields of all dividend-paying stocks that we track. This week, it is 2.2%. Thus, for our screen, I'm going to seek stocks that exceed that level by a decent margin. So I click on dividend yield, and I'm going to set the minimum to 3%. The current yield is important, but I also want to focus on companies that have a history of raising their respective payouts. The screener includes 1 and 5 year historical growth rates for several metrics, including sales, cash flow, earnings, book value, and for our exercise, dividends. So let's add the 5 year growth rate for dividends, and we'll set the low bound to 10%. Admittedly, this is a rather aggressive figure and easily outpaces inflation. down to just 6 results, which is nice and manageable. Let's take a look at the 6. All of these stocks may fit nicely in a portfolio that values quality and favorable earnings and dividend prospects. I personally evaluated these stocks earlier today, and following my research, I've decided that Cracker Barrel Old Country Store, ticker CBRL, is today's one stock to buy right now. Before I provide more information about Cracker Barrel, please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name will take us to the digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These boxes can be moved around, resized, or hidden, so you can create your own customized report. Once you alter the presentation to your liking, you can save the changes from the sliding action bar. The next time you come to the report, it will look the way you set it up. You can also apply these changes to other equities. The degree of familiarity with Cracker Barrel largely depends on where you live and/or commonly travel. Thus, I'm going to provide some background information, which can be viewed in the business description module. The company operates 660 restaurants and gift shops in 45 states, though most locations are in the South and Midwest. Restaurants feature an old country store motif, along with adjoining or separate gift shops, which sell early American reproductions and food items. Nearly all units are company-owned and located along highways. It employs more than 73,000 individuals and has a market capitalization that exceeds $3.8 billion. Moving on, our digital reports possess a great deal of information and analysis, so let's take some time to look at details about Cracker Barrel. One thing that quickly caught my eye was institutional ownership. This module can provide clues as to how hedge funds, investment banks, and, quote, the smart money feel about the stock. The bar charts are broken down by quarter, with gray representing institutional buys and blue sells. As you can see, buys have outpaced sells in every quarter since mid-2017, and lately the difference has been quite impressive. The peers module is also interesting. From the valuation tab, you can see that Cracker Barrel's PE is below its competitors, and its dividend yield is nicely ahead. I thought this was a nice combination. Moving on to the valuation module, we see Cracker Barrel's historical annual performances as well as Value Line's estimates for this year. The company's fiscal years end around July 31st. A quick scan reveals that CBRL should continue to increase revenues, earnings, cash flows, and other valuation metrics at good clips. Clearly, from a numbers standpoint, there's a lot to like here, and I encourage interested investors to review the many other modules that we provide. I now want to highlight our classic PDF reports, which are available for all digital subscribers. They are available using the button at the top right. Let's see what our analyst has to say in the commentary. Many subscribers consider this the most important part of our reports. Editorial analyst Justin Hellman stated the following in his recent report. Recent results at Cracker Barrel Old Country Store have been solid. In fact, the company closed fiscal 2019 in better than anticipated fashion, with fourth quarter share net of $2.70, sailing past our $2.48 estimate. While margin pressures persisted, healthy same-store sales trends, especially across the core restaurant segment, helped to lift the bottom line. Restaurant comps, notably, climbed 3.8% during the period, despite heavy promotional activity within the casual dining sector. The retail division, meanwhile, still accounting for about 20% of the top line, continued to perform unevenly, with same-store sales there rising just 0.4%. Mr. Hellman goes on to discuss some concerns in regard to competition and the retail side of the business. That's the gift shop operations. Its new partnership with Punch Bowl Social, a Denver-based concept that combines homemade food and cocktails with a range of entertainment like bowling and karaoke, will probably keep profit growth in check over the near term. However, he thinks Cracker Barrel will benefit from new menu items and an expanded delivery platform. In addition, the Punch Bowl tie-up, as well as the recent acquisition of Maple Street Biscuit Company, an up-and-coming breakfast and lunch-focused fast casual eatery, should benefit the bottom line over time. In fact, in fiscal 2019, the company achieved profits of $9.27 a share. By the 2022-2024 timeframe, we project that profits will surge to $15 per share. As for the stock, we think it should interest buy and hold investors, and it is today's one stock to buy right now. And with that marks the end of our formal presentation, and I will now tackle your question. All right, so give me 1 sec to scroll through the questions. All right, one person came in late and asked about the screen, so let me pull that back up. These were the fields I used. So safety ranks 1 and 2. Projected 3 to 5 year earnings growth rate of at least 10% a year. Current dividend yield of at least 3%. And then historical 5-year dividend growth of at least 10%. Next question, do you believe a person could buy a call or a leap on your one stock to buy? Pretty much all the stocks I mentioned have options attached to it, and we have a separate options product that can provide information on particular options that look good for the stocks that we track. If that's something that interests you, I suggest looking at the product or calling 1-800-VALUE-LINE for more information. Next question. I noticed at the bottom of the PDF, CBRL has been paying special dividends. Is this included in the yield? We'll take a look. This is what the participant is referring to. As you can see, this company regularly pays special dividends. However, it is not included in our yield or presentation. We only factor in the regular quarterly dividends paid into the yield. So you could think of special dividends as an extra or a bonus, but of course they're not guaranteed, even though the company has paid, looks like 4 or 5 years in a row. Another question about the dividend. The user states that it looks like the dividend payout is going to slow over time. That is true. If we look in the annual rates box here, you'll see that over the past 10 and 5 years, respectively, the dividend has increased 22.5% and 26.5%, respectively. And we think that's going to slow to 7.5% over the next 3 to 5 years. However, that's still a pretty healthy increase. Consistent growth in the 20s is incredibly difficult to sustain. There's a couple questions about past recommendations. I'm assuming that refers to these monthly webinars. And these webinars are a function of one-time in nature. We don't provide performance statistics or sell recommendations on these. However, Value Line does provide a number of products and model portfolios that provide such that. We tell you what to buy, when to sell, etc. How do you find dividend date on the report or next reported earnings? All right, we can use the PDF for that. In the footnotes, you'll notice that next earnings report, it's almost always in the footnote A or B. And then in footnote C, for instance, payments made February, May, August, and November. And for all dividend-paying stocks, we include that information right in the footnotes. Any concern about negative working capital? No, I personally don't believe that's problematic for Cracker Barrel. It seems like they'll have easily enough cash flow to fund operations and expansion. For instance, debt at $400 million is only 40% of capital, which is quite reasonable. What is the best VL measure of general market valuation and potential correction prediction? All right, I'll take a swing at that. So I don't recommend just one thing. I don't believe there's one statistic that can be used to evaluate any asset. However, each week, hold on one sec, I have to get the summary index. Yeah, I got logged out due to inactivity. I apologize. So each week in the summary index, we provide three main statistics that measure our overall universe of 1,700 stocks. So I mentioned the 2.2% in the presentation. That's the median of estimated dividend yields of all dividend-paying stocks under our review. So for instance, if you were a dividend investor and you were putting together a portfolio, you'd probably strive to exceed that yield for each position. For PE, this is how the universe is currently being valued at 17.5 times earnings. And then you can see what it was 26 weeks ago, the market low in March of 2009, and then the most recent market high, which was late July. And as you can see, we're pretty much in line over the past few months, but nicely ahead of 26 weeks ago. This will give you clues on how the market is currently valuing the average stock under our review. And I would say historically that's a bit high. The same goes for the median appreciation potential. This is commonly known as the VL map. And I invite you to Google that. There's been a lot of outside articles written about the importance of that statistic. It basically says that we think the average stock will increase 45% in price over the next 3 to 5 years. I can tell you the historical average is a little higher than 45%. While 45% is still healthy, it's certainly lower than the usual percentage that we dictate. But remember, 3 to 5 years is a long time from now. So that number is hard to be accurate, looking forward that far in the future. But as you can see, for instance, on March 9, 2009, when the market hit the low, we were all the way up to 185%, and that actually proved to be conservative. But to get a good idea of how the market is currently valued, I suggest looking at these three statistics each week. And they're updated each week. The VL timeliness rank for CBRL was recently downgraded. Why by now? Well, I didn't use timeliness as a factor in the screen. And our timeliness ranks are for the next 6 to 12 months, while I'm recommending this stock more as a buy and hold for the next few years. So thus, I didn't include the timeliness rank. General economic question. Any concern about the recent inverted yield curve on the 3-month and 10-year Treasury rates? Sure. In the past, this has been a good indicator of a possible recession, but I think it's worth looking at, but I'm not currently concerned about it at the moment. It seems like there's still more bullishness than pessimism in the market. It looks like the Fed will do what they need to do to keep the market afloat for at least the time being. Down the road, perhaps, that would be more of a concern. All right, that seems to be all of the questions. Thank you so much for participating, and have a great day.